Hospitality, so we're looking at hotels, motels, service industry. LA, the average price per room per key is just under $290,000 a key and an 8.1% cap rate. And you're seeing the RevPAR change, a slight uptick, really it kind of hung pretty steady. And 12-month occupancy rates about 72.5%. Orange County, a higher, average sale price per key at $367,000 uh, per per key, and average cap rate 7.5%. RevPAR change down 1.1%, so nominal. Again, pretty steady and similar 72.2% occupancy. It's a 12-month occupancy average. Inland Empire, you're seeing $207,000 per key and 7.7% cap rate on average. And 12-month RevPAR change is down 3.6%, so a slight decrease. And this occupancy is much lower at 62.5%. And San Diego, $375,820 per key, 7.4% cap rate, and 2.8% increase in 12-month RevPAR, 74.1% occupancy. Again, San Diego's been a very strong market. It's recovering quickly, and this has been consistent, strong demand in that marketplace. Um, so that's interesting. Again, if you'd like to, I email this out, once a month as well. If you'd like me to shoot you an email on this, you can reach out to me at chaspatterson.com. Happy to include you on emails I send out, given these market updates. So hopefully this is helpful at giving you a high level of what's happening in Southern California. And I'll also give you a couple more insights that I think may be of some interest. Not sure where you are in the marketplace, if you're actively looking or just generally trying to get educated on the market. Um, Interesting to see that the CMBS delinquencies, so commercial mortgage-backed securities, these are basically your loans, say multifamily, your Fannie Mae, Freddie Mac loans. You're seeing that the delinquency levels have increased. You see here that delinquency rate broke 7%. So it's surging up. 7% may not seem like a lot, but it looks like that's 2% higher than it was, just was it a year ago. So that's interesting to see. We've always heard this story, not always, but in the last year or two, we've been hearing a lot about the maturing debt, right? My experience has been we have not seen a ton of, uh, you know, debts, properties moving into foreclosure or REO, real estate owned. I've talked to several special servicers, and it's much more common, or has been much more common, for them to just kick the can down the road where they extend the loan another year, give the borrower another 6 months, 12 months, 18 months. And the truth is, they don't want the property. They don't want to take it back. So it's better for them to just extend the loan, and everybody's just hoping that they can the market's going to pick up, interest rates are going to come down, and they're going to be able to sell, that they're going to be able to refinance at a more attractive rate. Um, but thus far, the rates have not been great, and I'll show you that on the next slide here. We'll jump over to, just so you can have a sense of what we're seeing across different asset classes for these commercial rates. But you see a lot of times right now, if someone has to refinance their 3.5% loan that they took out 5 years ago, and now they're looking at loans that are in the 6.5, 7% rate, that's a killer. They got to put money in to refinance. So it's no longer a cash out refi generally, like it used to be. It's a cash in refi. So in a lot of uh, owners aren't in a position to do that, or, and they have to increase their level of equity in the property to keep the loan to value at the right and the debt service coverage ratio at the right levels. So it becomes very problematic. Speaking of interest rates, here's a lender that uh, has some current rates. They're saying multifamily. Their average is about 6.3%. They're saying a low of 5.45% and highs 6.85%. So, and generally you see about a 1.5% spread between the high and the low on a lot of these. For retail, office, and industrial, you're seeing an average of 6.8%, and the spread going from 5.7% to 7.5%. And triple net retail here. So there's a lot of times, especially if you single tenant um, properties, and that range is going to be 5.7% to 7.3%. And then depending where you are, you owner SBA loans, ranging from 5.3 to 8.1 for owner user properties. Bridge lending, you're seeing, 8.25 to 12.25%. Again, this is going to be, short-term loans, construction loans. You're going to see that going from 7.5% to 12.5%. Again, if you're a larger fund, a larger family office, more institutional, obviously you have um, more attractive options that are available to you based upon your balance sheet. These are just general terms that we're seeing out there currently. So at any rate, I hope this is helpful for you. Just want to give you an update on some specific stats across asset classes in Southern California. Feel free to reach out to me if you have any questions, if you'd like to see some information on anything else. Maybe happy to put together some other videos for you. Uh, just, I'm talking to owners and investors in this space every single day. Our brokerage, we focus quite a bit on putting together off-market opportunities. So we're constantly reaching out to owners of portfolios of assets in multifamily, hotels, industrial, retail, yeah, office, across the board, right? So we have off-market opportunities across all those asset classes, and then we have our database of legitimate buyers that are looking. I can tell you anecdotally that we're still seeing a little bit of a delta, a spread between the seller expectations and the buyer expectations. Sellers, a lot of sellers are not meeting the market where it's at just yet, and that explains the decrease in transaction volumes too. I mean, we saw transaction volumes drop, 60 to 80% depending on asset class, from norms, over the last couple of years. So, and largely because of the debt markets, right? So a lot of the deals just didn't pencil anymore. So we saw a huge decrease in transactions, and people are just looking for value now and opportunity. And there's still at times can be a 15% delta, sometimes 20% delta between what a seller's looking for and what a buyer's willing to pay. And when you can find that magic deal where you can get everyone on the same page, you need to take advantage of it. Um, anyway, I hope this is helpful. Take care. Reach out to me if you have any questions. Have a great day. Bye.